this refinancing risk starts to become more and more real because I think more so in high yield than in IG. I believe something in the region of 20% of high yield, maybe in euro, a bit more than 20% in euro high yield is going to mature in 2024 with a lot of names needing to refinance almost 200 bips more expensive than they did before. And the section that maybe gets hit the hardest is the lower quality section, like the triple Cs, because around 40% or more of these issuers will have to issue way more than 200 bips more expensive than what they did before. And this becomes a significant challenge, right? We saw how higher interest rates and higher funding costs have been a significant issue for some industries, for example, real estate, and it will continue to be challenging for a lot of these other issuers, especially in high yield. We've yet to see, we will see, I suppose, in 2024 how these issuers will handle, this maturity wall. And also we have to remember that spreads are very tight because default rates have been particularly low last year and even the year before, mainly because of a lot of support from a lot of liquidity, right? That is not artificially, but that is being the liquidity that's being provided for by central banks, and this is coming off now. So without this liquidity, buffer, it's going to be tough, right, for these guys.
That's the thing. I mean, what you said is spot on. Like default risk, likely to go up.
Yeah.
Just because of refinancing walls.
Yeah.
And everyone is aware of this situation. Like any investor I spoke with is very aware. 2025 is the big wall for high yield. And 2025 means you need to refinance 2024. Okay. Having said so, and you say the keyword is whoever was late to the game, anyone that was late to the game cannot buy IG as rally too much. To have similar yield of what you will have obtained by buying IG a few months ago, you go down the quality. And everyone is buying like bad names or less good names and creating the compression between quality versus non-quality. Quality is rallying less than non-quality. Non-quality is going up more, and which is driven by accounts which is buying because of the yield. It's linear. There is no fundamental peaking between issuers in the fixed income markets or in the credit market in general, which I think is going to be the theme for 2024. We can go up the whole 2024, but some names will outperform others because it's a fact. This wall of refinancing will hit some of those names. So issuer picking, stock picking, call it what you want, fundamental analysis is the key for 2024. And I look back and I just think it's crazy. Like where we are trading right now is wrong. And, I always say, do you want to be Mr. Right or do you want to be Mr. Money? We want to be Mr. Money. We respect the market. You don't fight it and you wait and you witness. But it is wrong. And everyone is agreeing on this. It's just, it's just the threats and the risks are way, way, way too high. And where can we end up? We can end up in a liquidity crash because the support of the central bank was a huge liquidity providing exercise. Okay. Now this has been more than weighted into the new participant of the market, and especially the CTA market, which is double in size this year. The algorithm-driven strategy, which are buying credit just because a parameter like vol is low, for example. As much as been driving this year the price action by creating and contributing to this huge squeezing, everyone is happy when it goes in your favor. But what if the CTA strategy and the algos will push everything down because on their model will be a sell the credit and there is no marginal buyer gaps of liquidity? That is an exercise. I want to see it. I'm curious because it will happen at some point.